Hey there, my name is John Stevenson. Welcome to the Guaranteed Retirement Guy Show. So I get asked this question so much. Probably most of my calls I get asked this question. Is this a good time to buy an annuity? Are the rates good enough right now? Should we wait? Should we have bought a year ago? Is it a good time to lock in a rate right now, or should we let our accounts grow until, maybe retirement 4 or 5 years later and then buy an annuity? So very, very important questions. If you're looking to purchase an annuity, you have to make sure that you time it right. But at the same time, even if you don't time it just right, you can still get some very decent payouts. And so if you want to check out what annuities are paying right now, go to my website, go to johnstevenson.com, and you'll be able to see everything that is paying. You'll see the carriers, you'll see the different annuity contracts. If you're looking for lifetime income, look at the income rider calculator or a SPIA or a DIA. Those provide lifetime income payouts as well. If you want more flexibility though, and typically a little bit higher income, the income rider will absolutely show the highest results. So keep in mind that it will show some of the accelerated payouts on the top there. A lot of times NASA, Meritas, American General Life, they'll kind of show up on the top there. And those are basically higher payouts for 5 to 6 years, maybe even up to 10 years, but then they reduce pretty sharply after that, usually around 35 to 40%. So those are great for the go-go years, and people will buy those for that, or to fill a gap. Maybe you're delaying Social Security. That might be a great thing to purchase. But most of us, we don't want our income to go down. And so just keep that in mind. Usually those top three will, sometimes 4 of them will pop up on the top. But the rest of them, you'll notice that their monthly amounts are very, very close together. And that's how you can tell that they are guaranteed for life. So if you got questions regarding your specific situation, reach out to me and I'd be happy to help too. So it is a good time. I'll just tell you right now, with rates the way they are, when you're looking at high interest rate environment that we have right now versus what we had 5 years ago, it's a big difference. And because of that, yes, annuity payouts are much higher because annuity companies are making more money. And because of that, they're able to give you more guaranteed lifetime income. If you're looking for a MIGA, like a fixed rate, they can give you higher rates. They used to be 2 or 3%. Now they're 5 or 6. So yeah, it's definitely a great time. So if you're thinking, is now a good time? Was it better a year ago? No, not necessarily. The last couple of years, things have kind of peaked and kind of stayed at their peak levels. And so you're really not missing out. You are getting good rates right now. People are locking these in right now for very, very good rates. So if you're looking for the best annuity, I would highly encourage you to check out the rates on my website. See what's available. And then if you feel comfortable, reach out to me. Okay. Well, I'm going to share my screen because I want to show you what a few of these, what the payouts right now kind of give you an idea. And you'll notice in all my videos, I'm always sharing my screen. I want you to see what's there. And these update, they change all the time. And so I like to keep you updated on how things are looking. So anyways, all right. So if you're looking at my screen, you will notice that there is a 57-year-old client in Massachusetts. They're putting $200,000 into an annuity, and this is just a male single payout. Okay, you can do a joint as well, but just in this example, I'm going to show you what the payout could be just for him. Okay, so if he were to put something into an annuity, he's 57 years old, and he's thinking to himself, I'm going to retire in 5 years. Okay, I'm going to take Social Security at 62. I want some more income from a portion of my assets. Maybe he's taking $200,000 from his brokerage. Maybe he's rolling it over from an old 401k or anything. As far as if you have old 403bs, 401ks, old employer-sponsored plans, you can roll them over before you're 59 and a half. But if you're in a current employment situation where you have a current 401k, you can't roll that over typically until you're 59 and a half. So just keep that in mind. Unfortunately, people will call me and they're like, yeah, I want to get this set up. I want to get this, set up for deferring income, for my retirement, but they're not able to access that money because they're still with that employer. So keep that in mind as well. All right. So looking at this person, if he were to let this go for 5 years, and you notice I have some of the accelerated payout options. I want you to see what those are. See how they're pretty high, like $23,630. Wow, that's pretty good. You're like, yeah, except it reduces to $14,000 a year at age 72. Not so good. So if I pull up the details on that, you'll probably agree with me that this is not something you want. Or maybe it is something you want. So if you look at the payout, you say, all right, $23,000 a year, and it's going all the way until, 71, 72? And then after that, it reduces pretty sharply. Now, this might be good. Maybe this is like, yeah, this is perfect because I'm going to vacation a lot. I'm going to travel. I want to spend more money. And I'm going to start Social Security later. And I might even have a pension payout that starts later. And this might make sense. Okay. And so for those of you that think this might make sense, then the accelerated option absolutely, actually might work. So, all right. So let's go back and we'll say, well, I want to see top annuity per carrier. And then I want to go up here and I want to say no income reduction. Okay. We don't want our income to reduce. We want the highest lifetime payout that never goes down. So looking at that, okay, it's not too bad. I mean, $21,000, $264, that's really good. I mean, you compare that to this top one, what is like, yeah, sometimes it's a bigger difference than that. Sometimes it's like much bigger than that. But in this case, it's not really that big. So yeah, I don't even think I'd even do the accelerated one. Yeah. If you can get highest payout, it's phenomenal. The type of income that you can get from only $200,000. Okay. So, and that is lifetime. So if you look at ClearSpring, this is the top one. Let's just kind of dive in and see what this looks like. Okay. So they're doing a 6.7% withdrawal rate right here. And they're multiplying it against a $317,000 benefit base. And that's because you gave the insurance company the money 5 years prior. So if you go down here, I'll show you what that equates to. All right, so what they're doing, all right, so they're giving you an income-based bonus of 8% right here. Okay, then they're doing a compounded roll-up rate of 8% on top of that. So what that equals is a phenomenal rate of growth. At the end of the first year, that account value for the benefit base, not this account, your actual cash account, it'll grow with whatever the index earns, okay? You've got the credits going in there, and you've got the rider charges right here. Okay, full transparency, these cost money, but the rider charges, at least you're getting something for it. And in this case, they're giving you an 8% bonus plus an 8% compounded roll-up rate guaranteed. So if you let that compound for 5 years, it's $317,375. You look at that and say, well, you know what? That's pretty comparable to my brokerage account right now. And the nice thing is you don't have to worry about sequence of returns risk. You don't have to worry about getting out of the market at the right time or timing it just right or hoping that we don't have a recession or an extended downturn right before you decide to take income in 5 years. Okay, people will do that and they think, well, I'll just keep my money in my stock account. I'll let it grow. I'll let it compound, right? And then at the end of 5 years, I'll buy an annuity. Okay, this is what this video is about. Is it the right time to buy an annuity? Well, if your account can grow like 10% per year and it compounds every year, then probably not. Maybe wait 5 years and then buy an annuity at the end of 5 years. But you better guarantee that your account's going to do that. And so that's why I usually would recommend if you're close to retirement, just take the portion of your funds that you're not wanting to be subject to that market risk and set up a base. Set up your base income for yourself. And you can do this through purchasing an annuity with part of your retirement funds. Okay. So going down here, you'll notice that it is getting guaranteed growth, grows to $317,000 multiplied by a 6.7% withdrawal rate, which by the way, is 2.7% higher than a 4% safe withdrawal rate that some so-called experts say is safe, which I don't agree with. 4% a lot of times is not safe. Okay. And you can argue that point, but if you go back to the lost decade, okay, go to 2001 to 2011, the market just went sideways. It went up, went down, went up, went down. And it was just a roller coaster that went sideways and you didn't get any real gains. Well, guess what? When people were retired during that time, and if they had this 4% withdrawal philosophy, they'd have big problems. Okay. Think about the .com. Okay. Think about the housing. Okay. You got all those crashes. And if you're taking 4% out, all of a sudden in order to maintain the same type of income, you got to raise that to like 8, 9, 10%. So you see how this is you got to think about this when you are planning for your retirement and just ask yourself what is worth the risk. Okay. And it's okay to have some of your money. I think risk is great and you can definitely get more reward from that, but it's nice to have a base set up so that you can do that emotionally and mentally and not back out when you know you shouldn't. Okay. All right. So I'm going to go back here and just again tell you, hey, yes, now is a good time because yes, rates are high. Okay. And if you're looking to defer this for 5 years or more or less, any kind of deferral is going to help you. Okay. What if you're in this position, but you're thinking, well, I don't want to retire at 62. It's way too early. I'm going to retire at 67 because that's when I'm going to take my Social Security. What will it do for me now? Well, a lot more, okay? If you were to stick with ClearSpring, it's now $32,876 per year for the rest of your life. That's guaranteed from just $200,000. Pretty good. So you go over here and you'll see, let's see that 8% roll-up rate. Look at that. So remember the original plan, take income at 62, 317 times 6.7. Yeah, not bad. But yeah, if you let that thing grow, now it grows to $466,000 multiplied by a 7% withdrawal rate. Okay, and that is guaranteed for the rest of your life. And if you look at this account balance, okay, it's going to run out. Look, even with growth. Okay, look at the growth here. It'll get, decent growth or no growth. It doesn't matter. But if it does get growth, it'll run out by the time you're 79. Okay, but the income is guaranteed for the rest of your life. That is what's important. That's why you buy it. You notice the rider charges eventually go away. Why? Because they're being taken from the account balance, not from your income. So when it comes down to just, hey, net high return for my investments, and I want as much as I possibly can get, and I want to enjoy this, then absolutely, I think it's a good time. So let me go back to one more thing. So all I've been talking about is lifetime income, but I do want to just pull up the fixed rates here. So MYGAs. MYGAs are multi-year guaranteed annuities. They're fixed rate. They are like CDs. And the nice thing is they can grow tax deferred even with non-qualified money. Pretty nice because you can't do that with a CD. So, all right, look at these. Let's see, top MYGAs. All right, you see 2, 3, all the way, usually 10. Sometimes you got some states you'll get like a longer term, but most of them are up to 10. But look at the 10-year. It's like 5.85. That's great. Now these are B++. If you want a higher rating, you'll get less returns, but you just kind of got to weigh the rewards and risk, okay? But these are still good companies. 5.8, that's pretty good. You lock that in for 10 years. I'll give you a little bit of advice on MYGAs. If you buy them, make sure you buy the 5, 7, or 10 year. Those are the best paying. Anything other than those, they're just the rates aren't as competitive. So that's what I would recommend. Okay, so 5.85, 200,000, gross through guaranteed 353. Pretty good. This is a lot better than 2% you were getting a few years ago, right? So again, if you're asking, is it a good time? Yes, it's a good time. These are great accounts to park your money, great accounts to strip off interest if you so choose. Some of them allow to strip off interest, some of them don't. So if you go down here, I say, all right, well, this one does not. So if I want to strip off interest, then I need to go with Farmers Life because they'll give me interest only, and it's like a 5.8 versus 5.85. So it's not even a big deal, okay? But that's what you would do. But again, if you're looking for highest lifetime income, and if you're thinking, I want to defer this out, I want to put this into a MYGA, let this grow, and then after 5 to 7 years, take my MYGA money out and put it into an income rider and get lots of lifetime income, you can do that. But keep in mind, it's not going to be as much lifetime income. Why? I'll just show you. The ending balance in 10 years is $353,000. Throw that into an annuity that gives you lifetime income, you absolutely can. But guess what? You compare that, okay? Compare that to an annuity payout. Let's see if I can find, 10 years. All right, so look at this. 10 years, $466,000. That's guaranteed. That's ClearSpring, okay? That's the result of having something set up for lifetime income. If that is your main goal, buy the income product first, okay? Because otherwise, you're rolling over a MYGA that's worth $353, okay, versus a $466. I'd rather have $466 multiplied by 7% withdrawal rate instead of $353. Okay, so you have to think about what is the end result of what's the end goal of your money, okay? And I have people that'll set up both of these. They're like, well, I don't want to use all of it for lifetime income. I don't want all of my money to run out. Okay, that's fine. Just throw your money into an income rider that gives you lots of lifetime income, and then throw some money into a MYGA if you want just a place to park it and get some more returns, and then maybe throw the rest in the stock market if you still want risk in the stock market and get higher returns. It's a great strategy. It's a barbell strategy. You're able to kind of get the best of both worlds. You get the guarantees, you get the base, the income base, and then of course you get the market risk and the returns and the things, the benefits that come from that, like hedging against inflation. So all of that is important. So it's nice to have a balanced strategy. And I have lots of people that buy these, both people that are not so wealthy and people that are extremely wealthy buy these. Okay, so there's arguments for and against, but in the end, you got to do what's best for you and for your goals. And in my opinion, I think that when rates are good, you should be taking a good hard look at them. So anyways, this is a very soft sales pitch. I hate being sold, But if you're looking for an annuity, I'd love to help you. Okay, go to my link. There is a link below this video. It goes directly to my calendar, and you can get onto my calendar, and we'll get on a Zoom meeting, and I'll answer your questions. If you are wanting to check out the rates first, then go to my website, johnstevenson.com, and check out the rates, and then you can book a call there as well. So again, I always encourage people, if you want me to help you buy an annuity, book a call with me. But if you don't, that's fine. Just use my calculators, check out and see what's available, and go elsewhere. Okay. I like to be transparent. I think it's really, really important. Of course, I'd love to help you, but at the same time, I want you to feel comfortable and do what's best for you. And hopefully this video is giving you some value, and hopefully that you're able to get all your questions answered. And if you don't, then ask them below and I will comment on them as well. Okay. So if you like the video, make sure you like, subscribe, share. I do appreciate you for watching. I hope this is valuable, and we'll see you next time.